Okay, thank you, everybody. This is Rob Barnes with Integrated Insurance Consulting. I want to thank Tom and Meyer Capital Group for allowing me to help educate you today about long-term care concerns and solutions. So we're going to get right into the program. There is a Q&A box if you want to ask questions, and we'll answer those along the way, or excuse me, at the end of the program. So today we're going to discuss what are the risks of potentially needing long-term care and what might the cost be. Most importantly, we want you to have a plan. We want to inspire conversation with you, your family, your advisors, and we want to help you create a plan. And so for some people who are currently self-insured, you might look at the different insurance options available. And if the risk is too big, perhaps you transfer the risk just like we do with car and home and so forth. We will be discussing the different flavors in the marketplace. And again, today's just the start of your education with us. We'll provide some other materials to help that and are available if you need to talk with us. And I will share perspective. You might share some perspective for the crowd as well, and Tom might add as well. So we'll get into this. I promise not to read my whole PowerPoint to you, but I'm going to start with reading two quotes that I like and pertain to the subject. One is from Terry Savage, a Sun-Times columnist speaking to a industry expert, and she says the most devastating thing that can happen to your financial future is not a bear market. It's the need for long-term care for yourself, your spouse, or your parents. Rosalind Carter, former First Lady, and she's also known to be the First Lady in long-term care. She did a lot to help people get recognized in this industry. There are only four kinds of people in the world: those who have been caregivers, those who currently are caregivers, those who will be caregivers, and those who will need caregivers. Now, most of my conversation today is going to be more logic and financial speaking, but I don't want to ignore the emotions here. And one surveyed client who was dealing with her mother with Alzheimer's, when she asked what she gave up, she goes, "I gave up my boyfriend, my house, my social life, my career, my freedom, life as I knew it." I heard Tom mention about caring for parents, and throughout the presentation, I can certainly tell you some of the things that are in my life, including my dad is dealing with Alzheimer's at this time. So long-term care, it's about asset protection. It's about asset leverage. It's about protecting your family and providing dignity and peace of mind. Now, one of the statistics that's most well known in the industry is one that came from the insurance industry back in 2011, that when you reach age 65, you have a 70% chance of needing care somewhere within the rest of your life. And another grid that's a little bit fresher from the Department of Health and Human Services kind of backs this up. And so when you look at the left side, here's the 30% chance of not needing any care. And when you team it with the chance of needing care for 1 year or less, we're about a 50-50 coin flip of needing care beyond 1 year or maybe not needing it at all. And so the ones that scare us, though, are certainly the 2 to 5 and the 5 to 5 years plus arena. So 40% chance that you're going to need care for 2 years and beyond. Now, the government chart shows a little bit different numbers on the left side. And I just want to, there's a lot of numbers flowing around. And I realize that it's hard to know which ones to believe. But something I want to mention that might be some of the differential in this 5-year pattern. My dad's been getting care at home for more than 2 years already. And I don't know that those things, the home health care stuff, when you haven't triggered any benefits on a policy and such, I wonder if they ever get counted. There's no doubt he's going down and at some point in time is going to need institutional care, but we're trying to do the best at the moment with home care. So some other statistics for you to be aware of. We know that more than half of claims start as home health care. We all want the dignity of staying in our home, but even home health care could run around $55,000 per year. And 30% of claims that are going on are nursing home, and a semi-private room can be as much as $93,000 or more these days for a decent facility. And what we do know is that women need care longer than men. And one of the things I tell people is walk in any nursing home in America that's about 70% women. And so women on average need care for 3.7 years and men 2.2. And then I have this grid looking at the cost of care today, cost of care 20 years out. And what gets scary, quite frankly, is if you need just the 3 years of care 20 years from now, that can be almost $500,000. And if you're a married couple, you still have to have a home for the healthier spouse. And if you need care beyond that, that's when real devastation can happen to your asset base. Now, I'm a big music fan and I'm always quoting music. If you hang around with me enough, I'll be quoting some lyrics from some songs. So I pull out Todd Snyder, his song Statistician Blues for you today. He sings that 65% of statistics are made up on the spot and 82.4% believe them, whether they're accurate statistics or not. But it's his refrain that hits home to the subject of long-term care. Too much to think about, too much to figure out. I'm stuck between hope and doubt. We hope we don't need care, and other people are doubting that they'll need care. But the reality is there's a significant chance that we'll need some kind of care. And so what do you believe? Are you planning for the probabilities or protection? What I can tell you from my perspective is all of the insurances that I deal with, I consider them to be safety nets. And so the tightrope of life is what you're walking. And the question is, how far do you want to fall? And how high do you want your safety net? Some other insight here. Now, I long for the day to get back to face-to-face meetings more, but no show of hands here, but I'm sure that there's people on this call currently caring for a parent, a spouse, or a child. And think to yourself, do you know anybody that's currently in spend down mode? In other words, they didn't have enough assets to sustain the care level that they need, and they need to do a Medicaid spend down process to get governmental help. What I want to emphasize, don't compare the pricing of long-term care products to other insurances because the statistics are diametrically different. I often get, well, wow, this is a lot more than my auto insurance. Yeah, well, it's a lot more likely you're going to use this coverage than use your auto insurance is the reality. And insurance is nothing more than a pooled risk, right? We all pitch in and the one who does is the statistic, is the one who gets the benefits. And, like all insurance, we want to have it and hope we never have to use it, quite frankly. But if I knew which people in the audience today were going to for sure need care, well, then we'd certainly suggest that only you buy insurance. But we don't have that foresight. And again, the pooling would never work if they only insured every claim. So don't underestimate the value of insurance. You might outinvest it, but I see that people confuse their pile of money with their liquidity of their money. And all I want to mention is that some of the products we'll look at today, all of them provide tax-free benefits. Whereas if you were pulling money out of a 401k or an IRA to pay for care, there's going to be some tax due. And if the stock market is down when you need to pull money for care, there might be some actual loss with it as well. And so we want you most of all to have a plan. Who's going to care for you? And how are you going to pay if you are the statistic? Are you going to self-fund? Are you going to rely on family? Will you rely on the government? Or does it make sense to insure for this risk? let's break these down a little bit. If you self-fund, of course, there's a big question of will you have enough? Now, something that surprises some of the advisors that I work with is that I have multi-millionaires that want long-term care insurance and they buy it. They understand the leverage value and the tax-free dollars and liquidity event, and they're willing and able to buy insurance. So again, I don't pick on people either way. If you want coverage, great. And if not, that's great too. What account will you draw from? That's something that you might want to discuss with Meyer Capital if you're going to remain self-insured. And something that I would add in here when people tell me they don't, and this is all asset-based reality here. If you're worth $10 million, you can definitely self-insure for long-term care. If you're worth with $1 million and have a married couple, maybe not. But if you have legacy plans and you decide not to have insurance, or even if you have modest insurance amounts, you might want to take care of that. So perhaps that means putting some things in a trust, an irrevocable trust, to make sure you have the legacy, or make the gifts to your kids before long-term care is even in your headlights. I'm also a big fan, and again, this is me talking, not necessarily Meyer Capital, but if you're not going to have coverage, you might want to look at a reverse mortgage line of credit when you're retiring, and that makes sure that you can tap the equity when you need it. And this is something that you have to have before you need it, just like insurance. You can see in there we talk about the stocks being down, or the cost of paying tax from an IRA account, which are all issues with self-funding. If you're relying on family, is your family able to care for you? And what will you do if or when they can't care for you? And most importantly, have you had a family discussion? What are going to be the consequences if your daughter, the statistics show it's as often the daughters, and what's it going to do to them physically, financially, emotionally? Are they even living close to you? Are they healthy enough to care for you and their families? And what will it do to their finances if they have to work less hours? Perhaps they have less income and less savings for their own retirement. So these are all concerns. And I certainly understand in my situation, I absolutely don't want my daughter to have to care for me. If you rely on the government, I need you to be aware that, some people have misinformation. Medicare does not pay for your long-term care costs. The only thing they will pay for is if you've been hospitalized for a certain number of days, they'll pay for up to 100 days of care in an institution while you recoup, but it's not a long-term solution. The long-term government solution means that you're going to spend down your assets and do a Medicaid spend down and have Medicaid pay for you. I don't know what the laws are in New Jersey, but I have them on the board for Illinois. That and I'm discussing this with my mom, quite frankly. Look, Mom, you're not going to last all that long with the assets you've saved, and they're going to let you keep 109,000 of assets, your house and your car, and we're going to have to consider putting Dad in a place at some time. And if you do go to a Medicaid facility, you might well be aware that they're less desirable places, and they're generally not you might not get a place close to you where you can even visit Mom or Dad. And you see on the board on the right hand, I have the word filial law. I'm not a fairmonger in my business, but filial laws are on the books in about half of the states. I did check that New Jersey does have these. To date, to my awareness, only Pennsylvania has started to enact some of the filial law. And what filial law means is if in fact your parents do a Medicaid spend down and the state is paying for their care, the state can come to the kids to recoup that. Certainly, I'm fearful of that in Illinois, but we don't have the law right now enacted. But I think long-term care is a societal issue. we're not going to be able to pay for everybody through Medicaid. We already know that, some of the government things are in bad shape. And so even though they haven't acted on filial law today, I'm suspect that they might have to start doing it someday. And that needs to, be filtered and factored into the decision making. And so, like all big risks and exposures, do we want to insure for them? This helps us preserve and leverage our assets, create tax-free benefits, and get the quality care when needed. And just as we consider transferring risk for things like home, auto, life, and health, we could look at long-term care. And that's what we're going to turn to right now. I want to go through the 3 different flavors of long-term care insurance, and we'll give an equal example to it. Just going to pause for a second. If anybody entered late, we are recording. You are on a listen-only mode, and there is a Q&A box where you can add questions, and we'll answer them depending on our time at the end of the program. So in our risk transfer options, we have pure protection insurance. This is known as traditional long-term care insurance. There's what I call payback and protection, and these are the hybrids in the marketplace. And there's a known outcome, which is a life insurance policy with a rider that you access to pay for care. And so let's break these down. In pure protection, it's generally the largest leverage for our dollar because it's pure protection. It's not promising anything back. And just to help with it, I analogize traditional long-term care insurance with auto insurance. You're going to pay, you're going to pay, you're going to pay, and unless you have a claim, you don't get anything back. Now, many states have some potential for asset protection when you have a partnership plan. And so those are certainly a plus that's not available in the other flavors that we'll talk about. But as auto insurance, if you have no claim, there's nothing coming back to you. And just like auto insurance, you are exposed to rate increases with very few exceptions in the marketplace. And I know that some of you probably have some horror stories, perhaps with your own policy or friends that bought them. And I've talked to a few Meyer clients already on some whopper rate increase situations that they're exposed to. But many carriers have pulled out of the traditional long-term care marketplace for many reasons. So there's fewer options than ever available today. And let's take a look at the numbers here so that we can compare. Now, I don't want to sticker shock anybody, but I want you to understand we're comparing an apple, an orange, and a banana. And although they all look different and taste different, we have to find some commonality. So what I've shown here is that Jack and Jill are each going to buy some long-term care insurance, and they're going to spend $10,000 a piece for 10 years. So they're going to outlay over a 10-year period of time $200,000 to buy the different insurance buckets we'll look at. And we'll compare these along the way too. Now, you may or may not be in a position to do that, but the numbers are linear. So if you could do half the number, then you can look at roughly having half of the benefits. And again, as stated earlier, I look at all of the insurances I work with as safety nets. So how high or low do you want your safety net? And a plan not only has to be something you want, but something you're willing and able to afford as well. So with Jack and Jill, we're looking at a combined policy for them with traditional policy, and their $200,000 over 10 years would provide a starting benefit of $5,500 a month per each of them. And they would have a total starting pool of $264,000. Now you see the big bucket to the right, and I say times 3. We also have a third bucket in here with Jack and Jill. So at age 80, Jack and Jill would each have a $475,000 bucket for each one of them. And then there's a third bucket of $475,000 that either of them can invade. So if one of them needs care much longer than 4 years, they can go up to 8 years by invading that third bucket. And of course, they could each have 6 years if needed. So you get the idea. And we're going to be comparing these in a few minutes to the different options available. So this is the traditional. I'm paying for pure protection. I'm getting the most leverage for my dollar today. And that's how that one works. The payback and protection, just as it sounds, it's going to guarantee that they pay you your money back, whether you need care or not. And these are known in today's world as hybrids. So it's going to pay back. We can guarantee pricing on most of the hybrids in the industry, so there won't be a surprise later for us. We often have opportunities to quit and get our money back after a period of vesting. And the only negative really here is that there's limited funding options. So I can't pay this forever. I have to generally pay between 1 and 10 years on most hybrid policies in the marketplace. And all things equal, and you're going to see this again in the benefits being not as high as the traditional, but we're spending the same premium here. So a hybrid costs a little bit more, all things equal, but you'll have no surprises and you're going to get something back from it. So let's look at Jill. Jill pays again $10,000 for 10 years into her premium, and Jack's going to do the same thing, and we'll look at his bucket in a minute. After the 10th year, she's totally vested in the policy. And so if she decided to quit, she can get her $100,000 back. There's a death benefit. Now, often in earlier years, these death benefits might be a little bit higher, but in this case, no matter when she dies, she's going to get at least $100,000 back when she dies. So, you know, a lot of us men think we're going to go in our sleep, so we won't need care. And okay, we'll give you your money back, but you buy a hybrid for the bucket of care. So she's going to start out at $3,300 a month benefit. And at age 80, she'll have $5,900 a month available. And you can see down here that her total pool starts at $250 and goes to $456. So one thing to note here, again, we see a lower starting and monthly accessible amount, but this is a 6-year design, the way this hybrid, and that's kind of an optimal design for hybrid. So this is looking at both Jack and Jill, again, $10,000 a piece for 10 years. Here's Jack's bucket, how it's going to start and how it's going to grow over time. So at age 80, he's going to have over $500,000 available. Okay. And then there's a known outcome, which is usually life insurance with a rider. Now, I'm a fan of having guaranteed life insurance versus a projected policy. This provides a known benefit. It's also, we know what's going to be paid back. We're buying a life insurance policy, and whether we need care or not, it's going to pay that death benefit back. And whatever you need for care, the remainder of it will be there as a death benefit when you pass. It's somewhat that simple. Out of the 3 options, and I'll do a quick review here, when we looked at the pure traditional long-term care, it doesn't guarantee anything back to you. When we looked at the hybrid, it just guarantees your cumulative premiums back to you, the $100,000 you spent. This is going to make sure that it pays the death benefit one way or the other. And there are some unique joint policies. We'll look at one of them in a few minutes. And I've already mentioned a little bit the difference. You know, we certainly, we have all kinds of insurance policies, and we want you to have the right fit policy. And when I think of these things, a large reason why people gravitate to these other kind of long-term care solutions is they want guaranteed pricing and sometimes payback as well. So this is what we can do with $10,000 a year for 10 years for each of Jack and Jill. They're going to buy roughly a $250,000 death benefit policy, and they're going to have a high accessible amount right out of the gate. The reason being is we're getting access to 4% of the death benefit per month if we need care. And I'm a bottom line guy. So the bottom line is, tell me when you die and I'll tell you the value of having purchased this. And then you can decide if it was better to do this or try to invest. And so if Jack dies at age 90 the internal rate of return equivalent, in other words, spending $10,000 a year for 10 years in premium versus investing that money, to outinvest where the $254,000 death benefit is at age 90, you would have had to earn higher than a 4% net rate of return. Now, I want to mention that my number is net net, so you need to gross it up by some kind of management fee because Meyer can't work for free, and you also need to accommodate for some kind of taxation of the investment along the way or when you access it. And so our 4% net might be more attuned to a 6% gross investment. And since this is a guaranteed policy, just want to fairly compare to investing your way out of long-term care if that's where you think. And most importantly, this is our comparison page. And I want to go through this with you with a focus on age 80. And I want to give you a couple of tools, and we'll do this for a couple of minutes here. But to me, when you have a long-term care insurance policy of any flavor and you go on claim, there's two really important questions you're going to ask of any insurance product. How much are you going to give me, and how long are you going to give it to me for? Those are two real key questions. And so I've learned only hindsight's going to be clear for me. I can't tell you which one's going to work out the best for you because I don't know what's going to happen to you. I don't know if you're going to pass away in your sleep 3 years from now, or 15 years from now, you're going to be stricken with Alzheimer's and need care for 10 or 15 years. But that's a game that I encourage you to play and discuss amongst your family and other advisors as to what makes most sense. So when we're looking at it and this is just Jill's numbers here for a second, at age 80, Jill has almost $10,000 a month, and she has a little under $500,000 protection. But don't forget, Jill also has that shared care bucket. So technically, she has around $950,000 of accessible money. If we wanted to be fair and split the shared care bucket in half between her and Jack, but the shared care just is kind of a flexible extra protection because one of you might run longer than needing more than 4 years of care. When you look at the hybrids start at a significantly lower monthly amount, even though the Jill's bucket solely is close, but it doesn't have any shared bucket to it. And by age 80, she has $450,000. But note, it's a 6-year plan. It's going to take 6 years of paying this $5,900 before she gets the full $456. So ask yourself, if you needed 1 year of protection, 1 year of care, I should say, down the line, which one of these do you want? You know, a lot of people, you might do the hybrid, you might do the traditional, depending on how long you need care and when you're passing and what your remaining death benefit is. The guaranteed life insurance with rider is a static design in the way that we have it designed here, but it immediately offers the highest monthly accessible amount, and you know that it's going to stop paying out at $267. And so just to be clear, and now we go through all three options. At age 80, if we said Jill needs no care, she dies in her sleep, we want her to have the hybrid, or the life with rider, right? Because her family gets $267 back, not the $100,000 from the hybrid. If we said she needs 1 year of care and that care year is $100,000 of cost, and then she passes away, you still probably want the life with rider because it's going to pay 100 of the 167, and then it's going to pay the balance of it at the end of that year when she passes away. If you're looking at the Alzheimer's claim, there's no question we go all the way to the traditional. So what you can see here, and you can play the claims game all you want as to what's going to happen and when and how devastating and all that, but the longer you're expecting to need care, the more you'll probably gravitate to a traditional, and the shorter, or thinking you don't need any care but you're going to get it just so your wife will leave you alone, then the life with rider might be the better option for you. Anyway, I hope that helps. And if you're looking at all of these and saying, hey, none of them are exciting to me, and before you say, I don't want any long-term care insurance, you might want to consider these joint life options. There's a couple unique options in the marketplace. I'm going to mention this one for our call again. It's the $20,000 for 10 years. That's the same premium outlay as the other options. Our benefit is $681,000, but here's the limitations to it. We're only going to pay that $681,000 death benefit at the second death between Jack and Jill, or if once the first person passes away, then that full $681,000 is available at $13,000 a month for the surviving spouse. So imagine if you have a $1.3 million estate, you're not so concerned about a shorter duration claim. You can handle 1 year for one of you. But if you're worried about a longer claim, or you drain down, what if you drain down the bucket at the first person to get sick and the surviving spouse doesn't have quite as many assets around? And that's where this is kind of a stopgap or a safety net in case you are wrong and both of you need care for quite a while. This helps protect the surviving spouse. One last thing on this policy, it would pay benefits, a combined $13,000 a month. If both spouses needed care at the same time, then the benefits can be triggered for it. But it's mainly for an extra safety net in case we're wrong. We spend some money on the first spouse, then they pass away, and the second surviving spouse is there and left with less assets and more concern of how they're going to take care of things. And note this, when we looked at Jack's life policy at age 90, the yield on it for him was only 4% net. At age 90, if the second death were to occur at that time, this gets to a 7% net rate of return. So these are the different insurance options available in the marketplace. We do have a few minutes left here that I'm going through things, but I just want to emphasize, if you came in late, please do ask any questions through the Q&A. And Tom and I will open it up, and I'll be on video here to answer the questions part. But a little bit more in a picture that'll help you look at these and put this all in perspective, that whether you're going left to right, but I'm going to start all the way to the right and come back left, that the biggest bang for my insurance dollar is traditional long-term care. Next to that are hybrids. Next to that are life insurance with the accelerated riders. Now, although I didn't address them, the annuities that are in the marketplace provide some leverage as well. And sometimes people have money in an annuity where they don't need that to live off of. And that's the bucket we use. So we stay with the annuity solutions. But the annuities really fall under the hybrid category. And of course, self-funding, there's no leverage. You're going to spend $1 to pay $1, or perhaps spend more than $1 if there's cost to access your money in any way when the time for care comes along. So again, I mentioned hindsight is 20/20. I don't know. I play the claims game with a lot of couples out there, and what I want you to know is that there isn't a panacea answer for any of you. And often, I'm working with a doctor and his wife right now. There's a significant age difference of about 8 years that the doctor's older, and he's buying life with rider and he's buying a hybrid on her. So he's concerned about long-term care. He's concerned about legacies for the kids, and they understand setting some of their money aside into a tax-free access of or tax-free benefits later on makes sense for them. So don't think you have to do it. I've had some people buy 2 different products on themselves as well. So there is no panacea, and it's what's right for you. And we're here to help discuss that as you like. And for those who often I get asked, when's the best time to buy long-term care? I'm going to share my story that I'm in my 50s. I'm 58 to be clear. 5 years ago, my wife had a major stroke herself. And unfortunately, I had not bought her long-term care before then. I did have mine. And I, like you, have my limited means and can't do everything all the time. And anyway, we're hoping she's had a great recovery, quite frankly, and we're blessed over that. But we did try a couple years back to get some long-term care, and we're going to try again as she stays clean and distances herself. She might become insurable again, but the point is you can kick the decision down the road, but it isn't just money, it's good health that buys long-term care insurance. And again, leveraging for tax-free dollars might make sense, especially for people who have a lot of money in qualified, and that might be the only place they can draw from. And as mentioned before, if you have legacy goals, you may want to take care of those with or without buying any long-term care insurance, because there are situations you could buy coverage that will also run out if you're one of those unfortunate, really long duration claims. And so you need to ask yourself, should you remain self-insured is the question here. So I'm just going to forward ahead in a minute here. And again, nothing, if you don't have pen and paper around you, don't worry about it. But these few pieces, as we mentioned, we just wanted to start your education today or accelerate your education. And we're going to provide some material to help carry that on. But I'm going to share a hidden client portal on my website. My website is really for advisors. Those are my direct customers, and I help them with their customers' insurance needs. But we just rebuilt it and put a lot of material in a hidden site, and we'll share that in a second. But this kit is on there talking about the stats and the care, and you'll note that grid, that pie chart that we started out with. We have our questions are the key pieces on there, which help you ask a lot of tough questions of yourself and your other advisors and your family. We have an article that goes through the pros and cons of the 3 different flavors that we discussed. And there is a short video of there, and you'll get the replay of this. So, consider how long-term care is a family and a lifestyle problem. Have the long-term care conversations with your family or other advisors. And think about how your portfolio might be impacted if you had a claim, and with or without insurance, how do things look? And evaluate if insurance is something you want to discuss further or even eligible to get, depending on your current health. And certainly work with your advisors at Meyer. And if you have any technical questions or so in the insurance arena, you can certainly reach out to me. So if you would, this is the only thing to jot down for today, but we'll resend this out. We'll have Mike Meyer send out a link to you with the recording and a couple other pieces that aren't yet on our website. We just ran into a nice caring brochure that talks about the what happens when people are strained with caring for their parents or their kids as well, or spouse, I should say. So if you go here, there's other stuff on there to learn, and there's a picture of my mug for you. But I'm going to open it up to questions here, and give me 1 second. I'll share my current face with you, and then let me get my questions box. And Tom, do you want to add anything?
Yeah. Hey, Rob, that was great. I mean, again, so complex. There's just so many things to consider about long-term care. Of course, we have these new options now with the hybrids and the life insurance with the rider for long-term care. But health is so vitally important. not necessarily, well, age also, obviously. But I do have I have a question about, the providers themselves. And I know, you have 50 different carriers and what have you, but, we've had clients that have come with us, to us, and we'll just say what it is, Genworth, which I believe was the largest provider of long-term care. And we know that they were skating on very thin ice there for some time, and maybe still are for that matter, because of course the bean counters didn't realize that people would live as long as they have been and interest rates would be zero.
Right.
And I mean, where do you draw the line as far as providers? It's not, you might be able to get the cheapest price out there, but the providers is so vitally important.
Yeah, Genworth is a unique situation, to be clear, but somebody has a question in here about Penn Treaty. And Penn Treaty is a company that was one of the first companies in the long-term care world. And they are in a bankrupt mode. And in answering part of his question with yours, each situation needs to be looked at per the circumstance you're in. So if you're healthy and you want to look at other options, you're not, I all the time, in the last 10 years, as a lot of price increases have happened on existing blocks of business for traditional long-term care, advisors would call me and say, hey, my client just got a 30% increase. Can we do anything better? In all of those situations, it was extremely rare that you would ever buy a new policy that would be anywhere near the value proposition of your old policy. And so here's where I'm going to say this is the beauty of the state insurance pools. And what we've learned from Penn Treaty is that because I live in Illinois and we're broke, as you might hear out there, and also dangerous, right? If I don't comfort people to say that if your carrier goes under, the state of Illinois has got your back. That's the point. That's not a comforting thing when you come from a state like Illinois. And New Jersey isn't all that much better, I think, as well.
New Jersey is not that much better.
So, but what is there is that there is some guarantee. And so one of your customers who came with us on Genworth, we discussed just start cutting back on the policy, maybe reduce or remove the inflation rider. Stop. I don't want you to get rid of your policy because I can't get you anywhere near one, even with the new cost. It's still a value. And I end up sometimes quoting coverage just to prove to you, look, here's new coverage close to your policy. You're still much cheaper even after the price increase. And as bad as it sounds, that still shows there's some integrity in the numbers, right? That they price something for you, and just because you took action years ago, it's still better for you today. And having it and with the low sustained interest rates, I can tell you the optimal time to buy a lot of insurance for me was about 12 or 13 years ago. Everything has gone up since then. And one of the things we learned, and a lot of people don't understand this, and this is why we have a little bit more confidence in today's prices for traditional care. Certainly you flee to the other things that are guaranteed if you have any concerns. That's the beauty of having 3 different flavors to insure for. But if you, I'm forgetting my train of thought there as to where I was heading on here. I'm sorry. Trying to read this half question of the Penn Treaty as well. If you're buying today, it's the way they price it, excuse me. What we know today and where companies have done differently, they priced a much higher lapse ratio into older products than what they observed. What that means is the company says, hey, we start out with 100 policies. Next year, somebody's going to quit. Not everybody stays till the end, but they totally underestimated the high percentage of retention of these policies. And so as many more people kept them, many more claims came in, and now we have to go and put the pool. For any of your clients on the call, I mentioned my regular website, which that address is on the board right now. my regular website, if you go to my newsletters, there is a Genworth newsletter on there. And I have a bunch of information. In fact, for the person asking the Penn Treaty stuff, I mentioned them in there. And that kind of gives us the roadmap of what to expect. And so I don't want to, Stephen, I don't want to tell you on a phone call when we've never talked what to do with your policy, but my reservation is to think of keeping something versus getting rid of it, because the state is paying the claims now. And the beauty of it is it's not just the state of Pennsylvania is what we learned through this. So it isn't just the state of Illinois that backs up my policy in Illinois. We reach out to all the carriers in the US to pitch in their fair share when a company's gone under. And that's how we at least pay the guaranteed portion of those benefit pools that are out there. So I long-winded, but if you have another question, or hopefully I answered that to some extent. And Tom, any other?
Thank you.
So let me go to the questions in here again. Stephen, I tend to think of staying with your policy, but as I've directed to some recent Meyer clients who have Genworth, maybe you want to cut back on some of the benefits because your pool of benefit might be much higher than the state pool, and therefore you're never going to get more than what they're backing up. And that's a way to, you know, cut down the policy benefit and cut your premium a little bit. But we can certainly talk about if anything else is appealing to you. Give me 1 second here. Okay, so for the person asking about my 10-year premium for 10,000, we were using, and sorry that if the footnotes on there weren't readable on the bottom, and I probably should have said that, but we were using a 60-year-old couple in all of the examples. And we kept the money purchase equal so you could see how the benefits differ. And we were considering them standard risks as well. So it was a 60-year-old female. And noting your question here, then you're a little bit older, so your premiums are a little bit higher or your benefits are a little bit lower, whichever way you want to look at that. So somebody's asking, I'll read this question to the crowd here. If I have 500,000 plus that can easily be spared and used for my care, is it unreasonable to think I can use this for my care to self-insure? It's not unreasonable at all. What I would tell you though is I could probably take, and I don't know your age here, so this is a loaded thing, but what if I took 150 of that 500 and leveraged it into a $500,000 pool of care in a hybrid? Now you're not exposing $500,000 of your money, you're exposing 150 of it. And you can do something else with the other 350. So that's how I would look at that scenario. Again, I don't have your age or your health and those things in mind, and that can always change once we know more. And if you'd like to explore things, you know, we can certainly talk more, and you can reach out. Let me look at this question here. Yeah, so somebody's telling me they're single and they're approaching age 80 and essentially asking for common reasons which long-term care would be denied. I mean, quite frankly, things like bad arthritis, scoliosis, and you know, bad uncontrolled diabetes are things. Just at age 80, I'll be fair and clear that I don't have great leverage options at that age. So sometimes we kick we kick the tires on what is available to you. And certainly they'll look less desirable than some of the things we showed today as a 60-year-old. But I don't want to judge that. Again, there's safety nets. If I can take your dollar and leverage it into $2.50, you know, you're not going to turn your dollar into 2.5 by investing anytime soon without taking a lot of risk of that. So that leverage and your current age and the fact that you're you know, closer to needing care than other people, perhaps it could still be worth looking at. But I admit it's modest to slight interest in the products that are available at an age 80, and that's assuming you're in good health as well. But your question begs as well, and you know, I share with people myself. we have all kinds of things reach for our dollar in our budget in our household just the same. And I had already had long-term care. I own life with rider for whatever that matters, and I have $500,000 today, and I have another $500,000 that will be converted and paid for before I retire. So I'll go into retirement with $1 million life insurance policy that's either left to my family or used tax-free for care, but it keeps me from drawing down all my other assets as well. So it's just leverage and liquidity. I don't tell you that's right for you. It is the most expensive option, but if you're willing and able, and that's what I see more, there are stereotypes with certain financial planners that, their rich clients don't need insurance. They never talk to them about long-term care. And when they come to me, they tell me a different story. I'm concerned about it. I had an uncle who needed care for this. I don't want, and again, they understand the leverage value, and that's why they buy it. It's logical to them. So let me move on with questions. We only have 3 more, so if anybody wants to add some more, we did say we'd go to at least 4, and I can go longer if you need. How do my age and medical conditions affect premiums? Again, the older you are and the unhealthier you are, the more your premiums are going to be, or you're going to be to the point where you're uninsurable depending on your health. I will tell you that, we're not rookies here. So we don't go too far in the education and pricing things. In fact, I hate to ever price anything directly for a client until I've screened your health. The value is immense of just, I don't want to show you pricing you can't get, or I don't want to show you products that aren't going to be available to you. So one example, there are these hybrid products that were the middle. They're pass or fail. What I mean by that is they don't have any counter offers. So if you don't pass, you fail. And I know perfectly healthy people of sound mind who didn't do well on the cognitive testing on the phone call, and they failed, and there's nothing I can do but try another carrier and giving you another chance. Carriers won't give you a second chance to take that interview. So the younger you are and the healthier you are, you're never going to buy insurance. It's rare that, I shouldn't say never, but it's rare that you're going to buy insurance tomorrow that would be better than buying it today in my world. Another question here, do the underwriters take into consideration family history, or is it just the health of the applicant? That's a yes and a no. More than not, certainly traditional and hybrids take that into account, and you'll see that we ask those questions on our pre-screen form. Again, we want to filter down and show you realistic pricing that should be available to you. We don't want to spin your wheels or give you false hopes and such. Life with rider, it can affect you and it might not affect you, and often doesn't. So that's what I can tell you. It differs amongst the different products, and certainly carriers. I take somebody declined at one company and go get them issued at preferred at another company. And that's part of the magic that we work with. I don't tell you I do that all the time. We know when you're, we fight the fights we can fight with people and think we can win. And so I've argued with declines from carriers and have won, because we listen to you and we hear you, and we, all they see is the black and white of your medical records. And sometimes a doctor writes something in your medical records that he didn't even tell you. And of course you didn't know to go do this or so. So it's anyway, the underwriting process matters, and who's working with you to help with that matters as well. So yes, it can be a concern, and we'll tell you which ones are. So are there tax benefits to owning a long-term care or a life with rider? There are tax benefits both in the hybrids and the traditional plans. There are no, and what I am inferring by your tax benefits is that, can I deduct any of the premium, or is there protection under the partnership, which isn't exactly a tax benefit, but an asset benefit? You might be able to deduct some of the premium for a traditional long-term care and or a hybrid is the long and short of it. And Mike, you're asking that question. I do have an extensive producer guide that gets into the tax issues and stuff with policies if you would like that. So Let me see. I think we've answered all of them. So, Tom, do you have anything else
Yeah,
you want to
yeah,
add
real
or
quick,
ask?
we got a few more minutes.
Okay.
So when you do life with rider, like I'm just curious, do they put you through that whole questionnaire as they would with just a long-term care policy if you bought a policy with a rider for long-term care?
Yeah, it's a lighter level of it. I want to be clear and step back a second too, that there's the most confusion in the marketplace is the life with rider area. And the first thing to look for is the rider a dollar for dollar reduction of the death benefit, or is it some reduced version of it? So what I call inbred riders, and I use that word to say, there might be something wrong there. You don't get dollar for dollar. So we want you to have the dollar for dollar drawdown ones. And usually those are underwritten as well. So we have had people approved for the life insurance and denied for the rider. And so when I'm in that situation, what I've done in times is I went to one of the carriers with the inclusive rider that they don't underwrite. That isn't a dollar for dollar reduction, but the longer your claim and the older you are when you have it, the more of the policy you're going to get as well. So again, we show you the best we can get. If you can't get the Rolling Stones, you can't always get what you want, but you might find something still worthy of getting, is the reality. And I'm just into helping you explore the insurance options and see if something strikes you and your clients. And the faster you and I get to you do or don't care to buy any insurance, the better off we both are. And that isn't that we rush you through things. It's just not everybody's going to buy coverage even after looking at it or getting an offer.
And last but not least, when it comes to premiums, let's go back to the ratios again. Is it 60% to 65% of long-term care policyholders do not utilize long-term care? Is that a fair assumption?
You know what? I don't have a stat that I'd be comfortable sharing on the.
Oh, maybe it's the other way around. I'm sorry. 60% maybe utilize it, 40% don't. Whatever the case may be, it's just in the thought process of wasted premiums. That's why this whole hybrid thing is really something where it at least if you do not use long-term care, your premiums don't go to waste.
Right. And that's what people, so the hybrids are popular today. I'll make this mention to you from where I sit in the industry. The future of the industry, the older you are, the more people are buying hybrids than they are traditional. And the younger you are, and think about this for the kids and grandkids and stuff of all your clients on the call, life with rider is the future of long-term care, in my opinion. I don't say it from any other angle, but it's a known outcome. You won't have a bad taste in your mouth because I hear the arguments. I didn't say these earlier, but the two most common arguments I hear from people when we bring up the subject, a lot of women will tell us we're all set. The family's going to take care of us. And the next question I have is, have you told them? Because, it's often just, we don't want to talk to you, scary insurance guy, so we're going to tell you whatever to shut up. And that's what I hear. From the men, I hear, well, I'm not going to get care. I'll get a gun. And of course, my question back, what if you don't remember where the gun is, sir? So it just, I'm not here to force anything I do or any of my products on anybody. They have value. There are people who are very happy they bought them. Even if it's traditional, like other insurances, I don't know when the long-term care industry turned to this, but we pay our auto and homeowners and we never quiver twice about, we know we have to pay them. It's, if my $500,000 home burns up, it's too big of an exposure for me to have to rebuild it. I have to have insurance. Now, albeit it doesn't cost anywhere near what some of the long-term care does, but so it's a matter of what appeals to people and whether or not they want that safety net and leverage and comfort.
All right. So We are almost a little bit over an hour, perfect timing. This was great, Rob. I really appreciate the time. And if anybody has any questions, please give us a call. And I mean, I know it's such a complex issue, and it's something that really needs a lot of thought that has to go into this type of a product or an insurance product. So thanks again, Rob. Everyone, have a great evening. Thank you for joining us. And until next time, take care.
You're welcome. Take care. Thank you for your time today.
See ya.